Hello and welcome to ET Interview. It gives me great pleasure to bring on board Mr. TV Narendran, CEO and Managing Director of Tata Steel. These are not interesting times, but these are boom times if you are in the steel business. In stock markets, they say steel is the new gold now. And this introduction has already brought a smile on Mr. Narendran's face. Mr. Narendran, fantastic to have you back. Thank you for joining us. I was rubbing my eyes when I looked at your PAT number. I never thought Tata Steel, which is a commodity company, will report this kind of an robustness in their profit. We are talking to you, sir, at a time when steel prices and steel demand is at a record high. So, Achhe Din are back, but are Achhe Din here to stay?
Thanks, Nikunj, for having me on the show. Yes, these have been good times for the industry, and rightly so. I think this industry has invested hugely in building capacity over the last many years, and I think we've struggled with a lot of challenges over the last decade. We are seeing more stability in global markets. We're seeing more discipline out of China as far as steel exports are concerned, and we are seeing demand coming back because many economies, including India, are investing in infrastructure. And Tata Steel, over the last few years, has grown in India very significantly. India has always been at world-beating profitability levels from an industry benchmark point of view. And so the fact that we have a 20 million ton capacity in India is demonstrating itself in the numbers.
Mr. Narendran, the steel cycle normally lasts for 4 to 5 years. Are we in a repeat of what we've seen in terms of an historical steel cycle? That this cycle will last for a couple of years at least?
I think the steel industry is going through a structural change. The steel prices will continue to be volatile, but will settle at levels higher than we've seen in the last decade. Fundamentally because China is going to be exporting less. Many other countries who are big exporters like Japan are exporting less because everyone has set a net zero goal and they want to manage production out of their own countries and not have exports going out of their countries, leaving a carbon footprint behind. Secondly, the cost structures are changing because carbon costs in Europe are there. Thirdly, the demand side is showing improvement with everyone investing in infrastructure. So I think there are some structural changes, which means that steel prices will remain higher than it has been for the last 10 years on an average. So I do expect that while there will be volatility, it will be volatile at a much higher level than it has been in the last 10 years.
Swing factor, Mr. Narendran, could be the new American administration program of Build America. Now, America is a net importer of steel and they are now looking at creating a new infrastructure. So do you think from a demand standpoint, it's no longer China, but it's going to be US and that's the benchmark which we should use now?
So what's happening in the US is that even as we speak, the hot rolled coil prices are over $1,800, So when we talk of high steel prices in India and the US, it's twice this. The cost of steel is twice that it is in India. Secondly, US is not a great market or not an easy market to export into because they have a lot of, in some sense, there's a lot of protection in place. May not be so evident, but it's very difficult to export into the US. Right? There's 232 and many other clauses available. So as a consequence, US steel prices will be high, US demand will be high. US is also a big exporter of scrap. So that means scrap prices will also continue to be high in the global markets. So US will certainly drive a lot of the sentiment in the steel industry, that's for sure, but may not be a great market to have access to because of all the restrictions they have.
While the steel cycle may be in a boom, whether it's India or whether it is China, but the problem is Europe. That is a slow moving part for you. Now, you've indicated in the past that you want the European business to become self-sustainable. How far is the European business away from what could be called as a Hindi term, Atmanirbharta?
So I think it still is already there. This year, the European business will certainly be significantly EBITDA positive. It's already PAT positive. It will be cash positive. So they are already Atmanirbhar. In fact, even last year, we hardly sent any money to the European business. So I think they're pretty much standing on their own. The Netherlands business has always stood on its own, and the UK business is also turning around quite well. So you will see much better quarters ahead because in Europe, we have a hangover of older contracts with lower prices. A lot of those have been renegotiated or have expired and new contracts have come in. So you will start seeing significant flow through into the bottom line in Europe starting this quarter. So I think Europe is already able to stand on its own.
While you're sounding confident to me, if I look at your 5-year capex plan and I'm looking at the number which is there in the public domain, is very modest. It's about $2 billion. Why is that?
So I think what we've announced largely in India is that we will complete the Kalinganagar expansion, which is 5 million tons. And that was already announced earlier. We'll complete that in the next couple of years. I think that's a primary focus. Beyond that, we do have the opportunity to go to 40 million tons in India in our existing sites. We said that that's not part of our capex plan because we've not yet taken it to the board and gone through due process. But we have that possibility. What we said since last year is first, let's get the debt down. Obviously, the debt is coming down faster than we had planned to from last year. And this year also will be strong as far as debt reduction is concerned. That gives us a lot of headroom to expand as and when we want and where we want. And then there are inorganic growth opportunities in India as well. So I think from a growth point of view, the India business is committed to go to about 40 million tons over the next decade. And we have both organic and inorganic growth possibilities to achieve that number. As far as Europe is concerned, the business will take care of itself. The capex required there will be more sustenance capex, improving the product mix, transitioning into a greener future, so on and so forth. It's not growth capex. Growth capex will be in India.
In a down cycle, Mr. Narendran, everybody talks about debt. In up cycle, everybody talks about capex. But you've given us an indication of capex. Let's talk about debt. In the non-declared capex plan, if you have to expand, do you think you will be able to generate enough cash flows to sustain them, or this debt to equity ratio could be compromised as you expand?
Typically the India business is able to take care of its own growth, okay? Because the India cash flows have always been strong. The India business, if you really look at it over the last 10, 15 years, the lowest point has been 20% EBITDA margin. Okay, that's not so visible sometimes because of the consolidated numbers. But the India business is fundamentally strong and can stand on its own even in a down cycle, can take care of its own capex. So growth in India need not be compromised even in a down cycle. What we've also said is in the long term, just now we are well within that. In the long term, we said we'll try to keep the debt EBITDA to less than 2. Today we are at 1.6 and it's going to go down further as we pay down our debt. But that's a headroom available to Tata Steel, even if we have to borrow. But I think the business at 20 million tons will generate enough EBITDA to take care of the growth that is required in India without having to borrow to support that growth.
Unlike IT and a lot of other businesses, steel cycle, like you said, is a cyclical cycle. This is a boom time, which means you would be generating a lot of cash and realizations will be higher. How are you planning to conserve the cash?
So primarily, like we said, we'll pay down the debt. We paid down debt by almost 27,000 crores last year. This year also there will be significant debt reduction. So you will see that playing out over the subsequent quarters. So there's a significant debt reduction plan that allows us the headroom to expand when we want to. So we are certainly going to make sure that our balance sheet is fixed for good, and we will be strong enough to participate in or pursue any growth opportunities that there is in India. We are committed to growing in India. We are very bullish about the prospects for steel in India, and we will invest to grow.
Annual report, Mr. Narendran, I'm going to just quote you. You've mentioned that you are looking at lowering your dependence on iron ore, increasing your dependence on recycling. How will this change your operations? How will this change the timeline of your capex? Because suddenly everybody is now insisting that check the carbon footprint and make the company more ESG compliant.
So I think what we were basically saying is while Tata Steel has traditionally been an iron ore and blast furnace based producer, we will pursue the recycling route also to grow in India. Our Southeast Asian business is totally on recycling. It's all electric arc furnaces, converting scrap into steel and downstream products. So what we said is particularly for our long products business, we will leverage this process route as an option. And we've already set up India's first shredder and organized recycling facility in Rohtak that has already started operational. We are scouting for an opportunity to build a mini steel plant there. We are talking to the different state governments there, and we are looking at using this kind of a model to grow in the north, west, and south where there is more scrap available than in the East. In the East, where there is iron ore available, our focus will be on iron ore-based growth. And we have 3 big sites in Kalinganagar, Angul, and Jamshedpur to allow us to grow there. So we will have a mix of both iron ore-based growth in the East and recycling and scrap-based growth in the Northwest and South.
Mr. Narendran, there are very few sectors in India which have seen complete consolidation. Telecom is one, steel is the other one. The reason why I'm asking you this question is that you said you're open to inorganic opportunities. But are there any inorganic assets really available in India?
Not so much in the private sector, but if you look at what the government plans to do, they've announced plans for Nilachal Ispat. We are participating in the process there. There's been talk about RNL. We are waiting to see what the timeline is on that. So we'll wait and see what are the inorganic growth opportunities. But in inorganic, we will be more focused on long products, because I think for flat products, our existing sites allow us the runway for growth. And when you look at consolidation, we should look at it differently from flat products and long products. Flat products is very consolidated, like you said, but long products is 40 to 50% secondary sector. The bigger players account for less than 50% of the production in India. So there is room for consolidation in long products as well.
We are aware of the fact that Tata Steel is now trying to build a branded steel business. As percentage of your turnover, how large is that, and what is the difference in terms of your long-term contracts with auto companies and other buyers versus when you're selling it in the wholesale market, or when you're selling steel or Tata Steel products as a brand?
So, the whole concept of branding, the way we do it today, started about 20 years back. So if you look at Tata Steel, the B2B business is the automotive, oil and gas. There we focus on the high quality products, discerning customers, approval-based business. So it's technically challenging to get in, and that's where we think we have an edge, and we focus our B2B businesses there. The B2C business leverages the Tata name, because the B2C business is about selling steel in single tons, 1 ton, 2 ton, 3 ton, for somebody who's building a house. And that somebody who's building a house is not a regular steel buyer and is willing to pay the premium for Tata Tiscon, for instance, which is a brand for rebars, or Tata Shakti, which is a roofing sheet brand. So they're willing to pay a premium for it because their life saving is going into building that house, and to pay 10-20% more for steel, which is 5% of the cost of building a house, is not so significant for them, for the comfort that it's a steel that they trust. So the whole business is built on that. It's worth about $2 billion now that we're doing. So it's huge. We want to target about 20-25% of our revenues coming from a B2C business, including the services and solutions that we are selling to those customers. So these businesses are stickier as far as prices are concerned, because the price depends on local issues and doesn't depend on what's happening in China or Southeast Asia or elsewhere. So this has been a strong business for us and continues to grow. And now another addition to that is we're doing almost 100 crores a month of this online. Consumers are coming online and buying that steel. We have a platform called Ashiana, and that did about 300 crores of business last year. We'll do about 700 crores plus this year, or rather did 700 crores in the year which went by, and we'll do 1,500 crores this year. And it was 300 crores 2 years back when we started. So, we're seeing a different route to market developing, different way of order generation and fulfillment. And these are opportunities that we want to leverage.
Mr. Narendran, the steel cycle is good, so whatever is happening in Europe right now will be overlooked, and the numbers and the realizations would be different. But what is the long-term plan to ensure that the European business, even in a steel downturn, is self-sufficient?
Yeah. So a lot of actions have been taken over the last few years. As you know, in Europe, we shrunk the business. When we first acquired it, it was 18 million tons. We shrunk it to 10 million tons. And most of that shrinkage happened in the UK, which was 10 million tons when we acquired, and now is 3 million tons. So between the 3 million ton plant in Port Talbot in UK and the 7 million ton plant in Netherlands, I think we have the right sites in Europe. Our Dutch plant, the Netherlands plant, is one of the most cost-efficient plants in Europe, well located, structurally strong, and should be able to ride the down cycle. It has always done well, even in the down cycle. We've had some operational issues in the last few years, but now we are, I think, back to normal. UK is where we've had a bigger challenge. And again, there a lot of heavy lifting has been done. So I think we are better positioned. Even while the UK numbers we don't report separately, they've been, till last year coming close to being EBITDA positive, and now we are very clearly EBITDA positive. And hopefully, this year we'll certainly be cash positive in UK as well. So I think we are better positioned to ride the down cycle in both these places. We are also talking to the governments, because in Europe there is a transition plan being developed by different governments, and the governments are willing to support industry because they want to decarbonize without deindustrializing, and hence they're willing to support industry in this transition. So there are conversations going on with both the Dutch government and the UK, the British government, to see what is the role government can play to help us transition to a greener future.
I go back to that point, sir, once again, looking at the demand supply, and especially looking at the demand supply both in India and also globally. How long do you think how much time do you think capacities would kick in? Because demand will remain strong, that's what indicators are indicating us. It is only capacity which in a sense could start having impact on steel prices.
Nikunj, the difference between what's happening today and what happened 10, 12 years back is very few countries are adding to capacity, right? I mean, between 2000 and 2010, when demand was strong, China was adding 50 million tons a year of capacity. It's no longer happening. In fact, China's cutting down on production. China is reducing exports. The only country which is adding capacity significantly, and rightly so, is India. So I think that's why globally there will be a better balance. The big exporters of steel in the world are China, Japan, Korea, Russia. Japan has already said they're going to cut down local production because they don't want to export steel. Korea also is expected to go that way. Russia is already also discouraging exports. So I think globally you will see a better balance in the trade, and capacity, if added, will largely be in India, which is the right place to add capacity because India has good quality iron ore and India needs more investments and needs to create more jobs. So I believe India will emerge as a reasonably large exporter. We are already exporting 1.5 million tons a month now. And, India certainly better positioned to be an exporter than Japan or Korea because we are a lower cost place to produce steel, not just Tata Steel. All our peers in the industry also produce steel efficiently and at a lower cost than most of our peers outside the country. So I think for India, when you look at Make in India, the steel industry is certainly an industry which can, which should be backed and which should produce, we should be producing steel in India. We are creating jobs in remote parts of the country, and India is a good place to export steel from. So I don't see excess capacity being built so fast this time.
We've seen murmurs and indications that some ministries are not very happy about the sudden price hike which has happened in cement and steel, and indirect hints have come that industry needs to be more watchful. Could that pour cold water on this brilliant steel story in India?
Honestly, the answer to rising steel prices is more steel production in India. And the answer to more production in India is investments in steel in India. And that investment will come if steel industry is profitable. If you look at the last 10 years, steel and power have suffered the most in terms of financial performance. You yourself said that, right? You never expected Tata Steel to have this kind of profit. But if you don't have profit, where will the money come to invest and create more capacity? And if you don't have more capacity, how do you manage prices in a globally traded product, right? So this problem of steel prices is not just an India problem. It's a problem globally. I told you these hot rolled coil prices in US are $1,800, right? So unless there is profitability in the industry, investors will not invest in the industry, right? If investors invest in the industry, you'll have more capacity, more supply. Hopefully that will temper the prices. So I think we should allow the industry to invest. And if they have to invest, obviously there would be some years where they have to make some money and deleverage their balance sheets, which is what is exactly happening. And if you really look at the industry, I think the steel industry together has announced investments of almost 100,000 crores over the next few years. Between all of us, I think we've all announced expansion plans. The money which is being made is getting reinvested in building more steel capacity. Hopefully that will help stabilize prices in India. But globally, if steel prices are strong, then obviously that will have an impact on India as well.
Now, Indian steel industry, Mr. Narendran, in the sense, couple of years ago was protected because of entry barriers. Does the industry need entry barriers now?
So again, I would like to clarify, entry barriers means what? See, anybody, anywhere in the world can invest in India to build a steel plant. You can't say that of most countries, right? If some Indian steel company wants to invest and build a steel plant in China or Japan or Korea, it can't, right? So we cannot go to many countries and build steel plants, whereas India allows any investor to come in and own and build a steel plant, own it 100%, invest in a mine, own it 100%. So we are a very free country from an investment point of view, freer than most countries in the world. The problem was when India was a market of being dumped, steel was being dumped, import duty for steel was 5%, or 2.5% or 0% for some countries with whom we had an FTA. How many industries in India have 0% import duty or 2.5% import duty or even 5% import duty? Very few, right? So that was a time when the industry said that there has to be some support because hundreds of, or rather tens of thousands of crores had been invested in this industry. And because some countries are having a problem and they want to get rid of 50, 60 million tons of steel, India cannot be the dumping ground. I think that was the primary point where the industry made. And yes, the government played a very big role in giving us that support, rightly so. So this industry has come back and is investing in India. So I think my answer to that question is anybody who wants to participate in the opportunity in India should come and invest in India, like all of us, and sell in India. And I think that's a great opportunity. It is aligned with the government's ambition of Make in India. And I think we are one of the freest countries as far as investments is concerned, and you can own the steel plant 100%. So I would push for that rather than say make steel anywhere and then sell it in India. How do you create jobs in India if you do that?
That's a great point. I mean, ultimately, steel sector has to do well for it to create jobs and in order to reduce our dependence on imported steel. But just to look on the other side, Mr. Narendran, the last question, which is that right now the export realizations are significantly better than domestic realization, and you got a rupee which helps you always. What are the chances that we could see a pushback on exports? I mean, this is something which completely can be controlled in terms of getting additional taxes on steel export just in order to control the prices.
Sure. I mean, obviously that's a government's prerogative, but I think most Indian companies are exporting between 15 and 25, 30% of what they produce, which is not so significant. But the other important point I want to make is, a lot of concern was to do with the steel being used in construction. Okay. Those are long products. They're hardly exported. Right. So if you look at exports of long products, it's hardly anything. Most of the exports is flat products. So I'm not sure if any export controls will help bring down the long product prices if they are high globally or they are high because of input costs being high. Because like I said, the problem with long products is 50 to 60% of the long products is being produced by the secondary sector. They are struggling with higher input costs. So I'm not sure if export taxes will help that problem.
Hypothetically, if we meet on the same forum and if we are discussing the quarterly numbers of Tata Steel, but the year is 2025, what do you think the headline would be? Right now, the headline is that Tata Steel has reported record profits. How do you see in 3 years scenario changing?
I think Tata Steel is fundamentally a strong company. We've had some challenges for the last 10, 12 years. I think a lot of them are getting fixed. Yes, we are riding high on a commodity cycle now, but I think you will see a structurally stronger and a future-ready company doing well.
Stay safe and thank you for joining us on this CT interview.
Thank you. Thank you, Nikunj, for having me.